Yeah, that's the age-old problem. One of the hardest things for an investor, in fact it is the hardest thing for an investor, is knowing when to sell. Being a good seller is a skill that I'm still working on. I can't recall the last person I saw who I could identify as a really good seller. Being a good seller is difficult, and I'm also fond of saying that selling a good stock too early is basically as criminal as not being on it in the first place. So you need to incorporate a perspective on valuation, which we do day in, day out. We know where value lies, we know where the benchmark or the small ordinaries is priced and valued at, and we know where our stocks and our portfolio are priced at. We're continuing to reconcile the difference between that. So it's having an appreciation where valuation is, but it's also appreciating that key ingredient, which is momentum. And momentum gets a bit of a bad rap. Momentum doesn't come in for the treatment it should, or the benefit it should. Momentum is actually what makes a fund manager his returns. The stocks you're talking about, well, there are several high-flying stocks, and Bursons and Mantra are probably two names that spring to mind. We're very aware of the momentum that's given those stocks a great shunt. They are both terrific businesses. They have all the hallmarks of the sort of companies that we like to invest in, starting from committed, professional and astute management, right the way through to favourable sectors in which they operate, and also nice earnings tailwinds. So they've got a lot of attributes. The trick for us will be when one does liberate a position there. They also have issues insofar as they are very well owned, to your point. They're also full of profit. That's another issue to be worried about. And the last time we saw this sort of phenomenon, of course, was the listed banking sector here in Australia, which were a sector that was well owned, well supported in everyone's portfolio, full of profits, and seemingly just going to continue upwards until of course that didn't happen and those stocks corrected. So that is how the stock market works. You have yin and yang, as they say, and stocks become very, very oversold and very, very overbought. The stocks I mentioned are feeling like they are a little overbought, but the fundamental underpinnings under both Bursons and Mantra, as just two examples of your momentum concept, have run hard, but I still think there's more upside left in those stocks. So we're happy with them. But it's just one of those things, coordinating and living with momentum and knowing when to unbend, when to stand off a stock is part of the skill of a professional manager. I've often talked to the Domino's case study as the great stock example of when to stand off a stock and when to stay with it, and how easy it would be to succumb to a valuation discussion with no regard to momentum. It's never easy when you're playing with stocks with very seemingly full PEs. Often they've got them because they've got seemingly defensive and reliable earning streams. Need to do the trade-off, but no doubt about it. Successful small cap managers at the moment are getting good numbers if they're appropriately reconciling valuation with momentum, and realising that in the case of most of these stocks, you've actually got to let these stocks run.